Good morning, everyone, and welcome back. I hope you enjoyed the previous videos. Today's topic is sources of capital, business angels, and venture capitalists. So if you have a company and you are starting your business or you want to grow your business, you have two main sources of capital that you can access. The first one is equity capital. The second one is also non-equity capital. So when we refer to equity, we are referring to the fact that you can sell a share in your business, for example, 5 or 10% of your business, in exchange for capital that someone else either will give to you and you just can spend it wherever you want, or most likely it will be an injection of capital into the company in order to sustain growth and follow on developments. So when we are looking at equity capital, there are two different sections. The first one is private capital. The second one is public markets or public capital. When you're a young company, you're probably most likely looking at the private section, and the IPO, initial public offering, or the stock market will only arrive maybe 10 years or 20 years down the line when the company is bigger, more successful, and well known. So looking at private markets, there is two sections. The first one is early stage. The first one is called Triple F, which is friends, family, and fools. Friends and family is people around you. Fools is a way to say people who are crazy to believe in early stage companies, new technologies, and they want to invest and see what happens. Then the second category is business angels, and the third one is venture capitalists. In the next slides, we'll discuss these in more details. The other side of private capital that happens more in later stages, let's say after 5-7 years when the company grows, is late stage private equity. Again, on the other side, when the company is even older and more mature, you have public markets. For example, in New Zealand, you have the New Zealand stock market, but also NASDAQ or New York Stock Exchange in the US. So as we previously mentioned, the second type of capital is non-equity. So in this case, usually you're not selling shares in your company. And for example, in the first category, debt, you are someone is issuing you a loan. So you're borrowing money from either the same players we discussed before, friends, families, or business angels or venture capitalists, but you might also have banks, for example, that give you a loan and you can use the money to grow your business. In some cases, you can also have financial institutions or public markets, but again, this is usually for older, later stage companies. On the other hand, we have some more creative ways to raise capital. So for example, you can have strategic partnerships. So if you are developing a drug, for example, you might have a strategic partnership with a more mature pharmaceutical company that believe in your drug, and so they will form a strategic partnership with you, provide some capital in exchange for more royalties later on, or maybe the possibility to market the drug once developed. A similar reasoning is for joint ventures. Someone might partner with you and, for example, in a certain country, and will give you some capital to start this venture and develop your product. When we are looking at franchising, is the possibility of someone to use your brand, your know-how, and they will pay you royalties to use this. For example, you can think of franchising as McDonald's. One example is McDonald's. Not every McDonald's restaurant is owned by McDonald's, but a large majority of these restaurants are franchised. This means that these entrepreneurs will pay some capital to McDonald's to use the McDonald's logo, the McDonald's recipes, the supply chain, and so McDonald's will receive capital in exchange for their branding. You can also have royalty agreements or grants. For example, grants might come from the government or non-profit organizations that are interested in what you are doing. So the source of capital that your firm can access depends on a number of factors. In particular, there are 4 types of factors. First one is type of business and type of product. So for example, if you're selling a consumer product, you might prefer to use crowdfunding as a source of capital. Similarly, if you have a blockchain product, maybe an initial coin offering is something you can look into. The second thing is the stage of business. So either your early stage or growth stage or late stage, these will change the type of capital available to you. So for example, if you're an early stage company, probably friends and family or maybe business angels will be more ready to give you capital. And thirdly, the capital structure, meaning the existing capital in your company. For example, if you already have a lot of debt in your company, maybe additional debt is either not a good idea or not available. And so depending on all these four factors, some types of capital will be more or less available. Let's look at something called the startup financing cycle. So here you will have time. So the firm starts here and then grows along the time. And then here on the left axis, you have revenues. So usually what happens is that firms at the beginning probably don't have revenues and mostly have a lot of cost. So this is called the valley of death, where a lot of startups fail. Maybe after 2 or 3 years, you will break even, meaning that you will not have a profit, but you will not have a loss. And so after this, you start to have profits and more revenues. So in the first, more risky sections, you usually have only seed capital available through business angels and maybe the triple Fs, friends, family, and fools. In some cases, maybe early stage venture capitalists, but usually they come later on. They want to have some more, they want to see more visibility on your revenues, on your metrics, on your customers, and so on. And so depending on the stage of your company, here you will have, for example, more earlier stage or later stage venture capitalists, maybe private equity firms here, and across the line you could have access to capital through acquisitions or merger or strategic partnerships with more mature firms. Once the company is very successful, again, after maybe 10 years, you will have access to public markets through an IPO. This is generally a general overview of timing and types of capital, and obviously it varies by industry, by country, but gives you some idea on the trend line of available capital. This slide basically gives you a different take on the type of capital available. So this takes the point of view of the investor in most cases. So there's a bit of mix of different types of capital availability, but basically when you access equity, when you provide equity as an investor, you expect higher risk, but higher rewards. On the other hand, as an investor, if you invest and provide a debt to someone, if you lend money to someone, you have lower risk and lower rewards. Probably the opposite is true for entrepreneurs. So if you raise equity, you probably are facing a lower risk, and we will see later on more in details this, but equity capital is more patient and you don't need to give it back. And so if your company has lower revenues, for example, you will still be able to continue your business. On the other hand, if you raise debt, no matter the revenues, no matter the economic conditions, you will still need to pay interest rates on your debt. And so this is probably a little bit more complex. Something that is quite widely used, especially in the United States, something called convertible debt. And this is in between debt and equity because it's basically debt that can be converted into equity later on. Here you also have some more types of lenders. So this slide is focused on agri-tech, but you can find similar information online on different industries. This slide is, it gives you again a sort of timeline of types of capital you can access along the development of the company, and also some indicative figures of the type of capital, the amount of capital you can be looking at fundraising from the different players. Again, this varies by industry, by country, by timing, so there's a lot of variation in this number, so they're just indicative to give you a sort of understanding of how much you usually can get. And usually you can start with bootstrapping, which is your own money. You can put 10, 20,000 in the company or more, depending on your capital availability. But if you have a high growth, high tech company, you most likely will need to have external funding, and the internal revenues will not be enough to grow and kickstart your growth. And so the next step is usually, again, friends and family, and usually they give you probably $50,000 to $100,000. Either US or New Zealand dollar, this is more or less what you can usually expect. Then once you are a little bit more successful, you go maybe on crowdfunding or business angels, and you might be looking between $50,000 to $500,000 in fundraising. Once your company starts to have maybe some more customers, some more revenues, maybe 10, 20 employees, you can start to look into debt, because maybe you have some assets you can pledge to the bank, or you can start to raise venture capital. And maybe here you're looking again between 100,000 to 500,000 in debt, or 200,000 to 2 million in venture capital. Again, this varies widely. I've seen venture capital fundraising of 10, 20 million, even in growth stage companies. And then later on, you can look at the strategic alliances, M&A, IPO, or private equity. And here the amount of fundraising, it's really, the variation is very big. You can be looking at 5 million, but for example, Uber, when was still private, was raising, I think, $10 billion. So the extent can vary and be very large later on. So there is also different types of capital sources that are not very widely discussed, because business angel and venture capital is probably a little bit more fashionable. But as a company, you can usually look at 3 other types of capital that are quite attractive, I would say. So the first one is called trade credit, and this is credit from suppliers. It's not always available, especially if you just started, so suppliers might not trust you, but they might allow you to pay, let's say, in 30, 60, or 90 days. And so you're basically getting credit for 90 days, and you can sell this product and then pay back your suppliers later on. Another one is called factoring, which is financing from receivables. So you can go to the bank and say, look, I'm waiting for $100,000 from IBM. They're gonna pay me in 90 days. Can you give me a loan for 90 days? And I give you the credit I have from IBM as a guarantee. Especially if your customer is a well-known company, well-capitalized, this might be a very interesting way to raise funding. And so you can get the IBM revenues instead of in 90 days, you can get them today, paying a little bit of cost in between to the bank. The last one is asset finance, also called leasing. So for example, instead of buying machinery or a car or a truck, you will get a leasing from the bank or leasing companies. This means that instead of paying, let's say, $20,000 upfront, you will probably pay $1,000 a month. And so again, you only need to invest $1,000 now instead of $20,000, and this will reduce your need for finance and for capital. So for example, let's have a small exercise in terms of trade credit. So if we go back, remember, trade credit is credit from suppliers. So you ask someone to pay them in 90 days instead of today. So if they offer you the extension for 90 days and no extra charge, is it cost-free? Well, unfortunately, nothing is cost-free, because free lunches rarely happen. So it might happen that they give you an extension of 90 days, but this probably comes with a foregone discount. So if they give you an extension, they're also probably willing to give you a discount. So think about this question. Would you prefer a 3% discount or a 2-month trade credit? Of course, this will depend on your situation, on how much capital you have, but will also depend on the cost of your alternative capital. So in this case, it's 3% discount or 2% trade credit. So if you can access alternative sources of capital, for example, you can have a bank overdraft for 18% interest rate a year, which one would you prefer? So pause the video and try to make the calculation. You prefer 3% discount or 2 months trade credit? And you need to bridge this 2 months trade credit with an 18% bank overdraft. Pause the video, make the calculation, and in the next slide, we will give you the answer. So looking at this exercise, again, you can look at a 3% discount. So for example, if you could receive instead of $10,000 bill, you receive a $9,700 bill. And this means that you need to pay $9,700 today instead of $10,000 in 2 months. How do you calculate? How do you compute for the difference? This is how to do it. So here you will need to do 3%. So remember, you can get a 3% discount. So you do 1 plus 3% at the power of 6. The reason why it is 6 is because you need to compare the annualized interest rate. And this, you put 6 here because this is 2 months divided by the 12 months that you have in a year. So you will have a 6 times 12 months in a year. So you do 3% at the power of 6. And this means that the 3% discount will cost you 19.4% in a year. So it means that if you go to the bank and ask for an 18% loan, you will basically save 1.4%. Okay, so the idea is that it is better to receive a 3% discount rather than the 2 months straight credit. Online, you will also find another exercise to try this again. So let's look at the advantages and disadvantages of the different sources of capital. Remember, you can have equity financing or debt financing among others, but these are usually the most used ones. So debt financing has a number of advantages. The first one is that you will keep full ownership of your company. If you're raising funding through a business angel, for example, they will probably get 5 or 10% of your company, which means you will need to share the decisions with them. If you raise funding through loan, through debt from a bank, you are still the full owner of the company. If you are using a debt, you are increasing your potential return on equity. Remember what we discussed in the previous classes about your leverage in the house? So if you have a loan of 50%, basically your return can double as well as your losses can double. So this allows you to increase and magnify your returns on your own capital. And also during periods of low interest rates, such as the current one, your borrowing cost might be low, and so it might be a cheaper source of capital compared to equity capital. Of course, there are some disadvantages. One of the main ones is that, as I mentioned before, no matter your revenues, no matter the economic situation, you will still need to pay your interest payments to the bank, which means if you can't pay, you will probably face bankruptcy or repossession, anyway problem. So this is not very flexible source of capital. At the same time, you might have some cash flow problems because again, every month you will need to pay your interest. And especially when you're a startup, your revenues might fluctuate, some customers might go, some others might come in, there might be, I don't know, Christmas season spikes, and so on. So your cash flow might be harder to manage. And of course, if you have a lot of debt, this will be a risk and might reduce your growth potential and development in the long term. In general, it's also very hard to fundraise debt when you're a startup, when you don't have many customers and many assets. And many entrepreneurs usually go for personal debt. So they usually use their own credit cards, or maybe they mortgage their house and then they bring the money, the capital into their company. Of course, there is risks. There is psychological risks, as well as the risk of bankruptcy of the company, which in that way will be turned into the personal assets. Because remember, companies are usually limited liability, which means that if the company fails, your personal assets will not be touched, unless you have given them as a guarantee to the bank. And so if this is the case, if you have raised personal debt and your company goes bankrupt, you cannot pay back your mortgage, they will take your house. So not only your company will be bankrupt, you will also lose your house. So this type of capital is usually available to entrepreneurs, but there is a lot of personal as well as psychological risks in using them. Venture capitalists and in general, equity capital can add value in many ways. So as for debt, equity capital has both advantages and disadvantages. One of the main advantages are basically the other side of the medal of debt. For example, you don't need to pay it back, it's more patient, but also it adds value. So in most cases, if you get the right investors, they might help you through networking, recruitment, follow-on financing. They might be experts in certain areas with domain knowledge. In general, they become your partners. They have experience, and so they might help you with coaching, contacts, and so on. So by having equity investors, you might partner with someone who might be able to help you and support you along the way. A bank usually doesn't do this. So equity capital might be a good way to receive additional resources and support along the way. Of course, this comes with some sort of conflict of interest or risks, because as in any partnership, there are benefits as well as costs. And so, of course, if you have someone in your company, you might start to disagree, you might start not to like each other, and there might just be conflict of interest. For example, the investors might want to sell the company because they have other needs, other strategic desires, objectives, and this might have a conflict with your own objectives. And so this obviously leads to fights and potential conflict of interest. This is a slide taken from the Financial Times, which probably exaggerates, but says business angels are devils in disguise. I've heard many stories of business angels starting to take advantage of the entrepreneur and generally just mess around. So it's very important, especially if you go for equity capital, to choose the right investors. So just to give you a few more backgrounds on selective financing decisions, when you hear about first round financing, second round, these are general terms, which basically means first round financing, as the word suggests, is the first one or the second one, and so on. You might also hear similar terms called seed stage, Series A, Series B. These are exactly the same thing. So for example, you might have first round financing, which is a seed stage, second round, which is a Series A, and so on. And usually this means that the company is growing, so it's not a startup anymore. In a seed stage, grows a little bit more, you have a Series A, Series B, and so on. This is just terminology for you to be familiar with. And this is the same slide I've shown before. For example, your first round of financing might be from friends and family, and then you might have a crowdfunding later on, and then debt later on. These are first round, second round, and third round. So again, just to give you a little bit more information on this sequence of funding, the first, it's usually called bootstrapping. Bootstrapping just means that you use whatever is available. So for example, you, instead of having an office, use your garage or your bedroom and work for free. And maybe you might mortgage your house to get some capital, you use your credit cards. In some cases, I've seen entrepreneurs bartering for products and services. If they are a software engineer, they're designing their own software, and maybe they give someone else a free website to design in exchange for some services. And so the capital outlays are much lower. As we mentioned, there is disadvantages to this because, of course, these will be very unstable and might be risky for the entrepreneur. But the advantage is that this is probably available and not much else might be available at that time. And you might not want to give up equity in the early stages of the company. If you're looking at friends, fools, and family, these are usually a significant source of funding, both in New Zealand as well as abroad. Your friends will be the people who know you the most, and they might appreciate your skills the most, and so will give you the first amount of capital you need. And usually this comes very early, when maybe you just have a business plan, an idea, they might give you 10,000 to support you in that stage. Your family might just do that for personal reasons, but again, there is cost. If things go wrong, both friends and family will not take it probably very nicely, and so this might push your relationship into some strain. So be very careful when you access friends and family for funding. Usually they're not sophisticated. In some cases, it's just a gift. Maybe it's a loan or equity. In general, advice is to define what the relationship is. Don't just say, oh, we will think about it later. because this is a recipe for fighting. So just say in advance, this is what I'm getting, this is what I'm giving you, this is the timeline, and so on. So just be clear on what is the deal, and this will solve a lot of headache, will prevent you from having headaches down the line. The next one is angels. These are just wealthy private individuals. Can be your doctor, your lawyer, a famous entrepreneur, whoever has some money to invest and they're interested in this type of companies, technology companies, or in your industry. And they invest their own money, and usually, again, they invest between $10,000 and $50,000 in each deal. And this is because, as we will see later on, they invest in many deals, and so the amount of money in each deal is usually not very high. They usually ask for a seat on board, especially if they invest a significant amount in the early stage round, but usually there's less formal control. They just want to have a look on how you're performing, and in many cases they just want to support you, especially if there is a good fit between you and them and the company you're running. Again, angel investors invest probably 50,000. They have a portfolio of 10 investments, and the total portfolio is 10% of their overall portfolio, which can include real estate, listed stocks, whatever you can think of. So their overall wealth in New Zealand, especially, might be 5 million. In the US, might be much higher, maybe 50 million US dollars. They expect a large portion of their investments to fail, as we have shown in the previous classes, and maybe 40% fail, 40% just survive, and maybe 20% of the investment will do very well and will manage to do well for their entire portfolio. When they invest, again, we mentioned this in previous slides, they will expect to make 10 times as much return on investments. Of course, again, 80% will not deliver, so the 10 times on the 2 companies that will be successful will make up for the other failures. They're usually long-term investors. They invest in the early stage companies, so they might not expect to make any money, at least for 3 years, but in many cases, you're looking at 5, 7, 10 years. If you go into more later stage, such as private equity or venture capital, the investment size, again, is much bigger. Probably the portfolio is similar size, but again, the overall money will be bigger. So probably 200 million, since the investment in each company is bigger. They expect similar returns, but in a compressed time frame. So they're usually looking to monetize within 3 to 5 years. So as a final slide for this class, this is the process for receiving capital. In this case, we are looking at ICE Angel, which again is a business angels group. So they, in 2014, but these statistics have probably remained constant over the years, they received 315 proposals or inquiries by phone and email. Only approximately 1/3 of these companies, they applied, they were sent to the deal flow committee. 1/3 of these, which is 10% of the initial submissions, were presented at an investment evening. And finally, only 19 were received an investment. So you can see you're looking at small numbers. For venture capitalists, the proportion of companies that actually receive an investment is usually 1-2%. So keep in mind that receiving funding from business angels, venture capitalists, and private equity firms is usually very hard. So a lot of entrepreneurs will try to get funding from other sources. So this is the last slide. I hope you enjoyed the class. In the next classes, we'll explain how to pitch to your investors in order to raise your chances of fundraising from them. Thank you very much for your attention. See you at the next class.